Good morning. The power of rate locks and why timing matters in mortgage financing. And interest rates move constantly, and mortgage rates can change multiple times within a single day, depending on movements in the bond market, inflation expectations, as well as economic data releases. And for homebuyers and real estate investors, this volatility creates uncertainty. And the difference between locking a rate today versus waiting a week can mean thousands of dollars over the life of the loan. And we saw this with the Iran conflict. And that's where rate locks became one of the most powerful financial tools in mortgage financing. And as a mortgage broker, I often tell clients that locking a rate isn't just a technical step in the loan process, it's a strategic decision that protects your financial plan. So, what is a mortgage rate lock? Well, a mortgage rate lock guarantees a specific interest rate for a defined period of time while your loan is being processed. And once the rate is locked, it cannot increase during the lock period, even if market interest rates rise in between. So, some typical rate lock periods can include, say, 15 days, 30 days, 45 days, 60 days, even as far out as 90 days without cost. And beyond that, usually you're paying money to secure an interest rate lock. But the lock period gives lenders time to complete underwriting, appraisal, and closing, while also giving the borrowers protection from market volatility. Why mortgage rates move so quickly? Well, mortgage rates are largely driven by the bond market, and particularly by the residential mortgage-backed securities market, or RMBS. And when inflation data, employment reports, or Federal Reserve commentary moves the bond market, mortgage rates can shift quickly. And some days rates move very little, and other days they move dramatically. So without a rate lock, borrowers are fully exposed to that risk. So let's talk about the financial impact of a rate lock. And even small rate changes can have large financial consequences. So let's give you an example. Say you have a loan amount of 500,000, a rate of 6.5, and that payment is 3160. But if the rates move to 7%, that's a payment of 3327, and that 0.5% difference increases the payment by $167 a month. And over 30 years, that adds up to a little more than $60,000. So locking a rate at the right time protects borrowers from these unexpected increases. So let's talk about when locking early makes sense. And in many cases, locking early is the smartest strategy, especially when you have a float down option if markets come down. But situations where borrowers often benefit from locking can include periods of economic volatility, or when inflation data is uncertain, or during Federal Reserve policy changes, or when bond markets are trending upwards in yields. So, in these environments, waiting can introduce unnecessary risk for you as the client. So, when borrowers might wait to lock, and there are also situations when borrowers may delay locking their interest rates. And if markets are trending towards lower rates, it might behoove you to do so. And when closing is still several months away, it might make sense. And when a borrower expects economic data to push rates downward, or if there's a Fed meeting. However, this strategy also carries risks, is the point. And the mortgage market can move quickly, and predicting short term rate movements is very difficult, and you're not always successful. So let's talk about why mortgage brokers can add value. Working with a mortgage broker who can provide an advantage to you because they can give you rate lock strategy. And unlike a single bank, mortgage brokers have access to multiple lenders and real-time rate pricing, which allows them to monitor the market closely and identify optimal lock timing. So at Medallion Funds, here are some of the things we look at. We look at mortgage-backed security markets, inflation data, and Federal Reserve policy signals. But also some lenders' pricing changes doesn't mirror the market as well. So this helps borrowers make informed decisions about when to lock their mortgage rate in. And rate locks provide peace of mind. And buying a home or refinancing a property already involves many moving parts, and a rate lock removes just one of the major uncertainties. So instead of worrying about daily rate fluctuations, borrowers can focus on completing the transaction and moving towards closing. And in volatile markets, the protection can be extremely valuable. So the final thought for the day is that mortgage rates will always fluctuate, but borrowers don't have to be exposed to that volatility. And a well-timed rate lock transforms an uncertain market into a predictable mortgage payment, protecting your financial plan and giving you the confidence you want during the home buying process. So if you're buying or refinancing or investing in real estate, understanding how rate locks work can make a meaningful difference in your long-term cost of borrowing. And that is it for the day, my friends. My name is Bill Rapp. Please visit my website, billrapponline.com. You can figure out how to get a hold of me. Love to talk to you more about your situation. Take care.